Today, we are going way under the hood of a true giant of global commerce, FedEx. What we're going to do is a really comprehensive analysis of their official Q2 financial report for fiscal year 2026. As a logistics bellwether, FedEx's numbers give us this incredible window into the health of the entire global economy. So we're going to get past the headlines and really dig into the numbers, what management is saying, and the key trends that are shaping this absolutely critical company. So the number that was everywhere this quarter is this one. A massive 47% jump in operating income compared to the same time last year. Now, for a mature, multi-billion-dollar company like FedEx, a swing like that is, well, it's astounding. It really makes you sit up and pay attention because it signals a major shift is happening. But a single number, especially one this dramatic, it almost never tells the whole story. Is this because the economy is suddenly booming, or did they find some new way to charge more? We really need to figure out if the company's foundation is as strong as this one number makes it seem. Let's find out. Okay, here's our game plan. We're going to start by taking apart that big profit number to see what's really driving it. Then we'll do a deep dive into the income statement, looking at where the money's coming from and where it's going. After that, we'll check the company's long-term financial health by looking at the balance sheet, follow the actual cash to see how real those profits are, look at the risks management has flagged for the future, and then finally, we'll pull it all together into a clear, evidence-based investment thesis. So, first things first. It is absolutely essential that we understand not just that profits are up, but why. You see, profit growth could just be a sign that the whole economy is lifting every company up, or it could be the result of some really smart, tough decisions made inside the company. Was this driven from the top line, selling more stuff? Or was it driven by the bottom line, getting way more efficient? Figuring that out is the key to understanding how sustainable this whole thing is. Let's really center our whole investigation around this one big question. Did this profit surge happen because they were shipping a ton more packages, maybe from a huge e-commerce boom? Or did they manage to raise their prices without scaring off customers? Or, and this is the third option, was this all about efficiency? An aggressive and successful cost-cutting plan that hit things like labor, fuel, or some big restructuring. Answering this is going to tell us everything we need to know about their strategy and how well they're executing it. And this chart right here, it tells the real story beautifully. See, this wasn't just about making more money in absolute dollars. It was about a fundamental improvement in how profitable they are. Their operating margin, which is just a fancy way of saying how much profit they squeeze out of every dollar in sales, jumped from 5.6% to 7.6%. That's a 200 basis point expansion. Now, for a company with over $20 billion in quarterly revenue, a 2 percentage point improvement like that means hundreds of millions of extra dollars are flowing straight to the bottom line. It's a massive shift in efficiency. Okay, so let's move over to the income statement to find the proof for that margin expansion. To really get how they pulled off that 2 percentage point jump, we have to look at both sides of the equation, the money coming in and the money going out. So, on the revenue side, the main engine was right here in the US. And what's really interesting is this specific driver. You can see the gray line here, which is ground home delivery and economy services. It shows a pretty nice jump in average daily packages from just under 7 million last year to over 7.5 million this quarter. This kind of suggests that consumers are still ordering a lot online, but maybe they're choosing the cheaper shipping options. Meanwhile, the other domestic businesses were pretty flat, which tells us the growth story wasn't across the board. It was very specific to that residential e-commerce customer. The international picture, though, is a completely different story. Both their international export and their in-country volumes were actually a little bit lower than last year. Now, this is a critical piece of the puzzle. It tells us that the revenue story wasn't some kind of explosive global growth. In fact, it kind of hints that the global economy is a bit sluggish, which really reinforces that idea of FedEx as an economic bellwether. The company's strength this quarter wasn't because of a rising global tide. It was very much concentrated in one part of the U.S. market. Okay, now we get to the other side of the income statement, costs. And this, my friends, is where the real magic happened this quarter. So yeah, salaries went up 7%, which makes sense with inflation and more packages to deliver. But look at the other two lines. Fuel costs dropped a helpful 6%. But the undeniable star of the show is this line, business optimization costs. It plummeted a staggering 91% from $326 million last year all the way down to just $30 million. These are basically one-time costs for big restructuring projects. The fact that they've almost disappeared tells us the heavy lifting of their cost-cutting plan is pretty much done. This one line item was the main reason for that 47% surge in operating profit. The story of this quarter was, without a doubt, one of incredible cost discipline. Profit is great, but an income statement is just a snapshot in time, right? It's like a video of a sprinter's race. A company's real long-term health, its stability, that lives on the balance sheet. Think of it more like a full physical exam at one specific moment. So, let's go check FedEx's financial foundation and see if it's built to last. Before we look at the number, let's just quickly define what we're talking about, the leverage ratio. In this case, it's debt to adjusted EBITDA. The easiest way to think about it is like a checkup on your own finances. It compares all your debt, your mortgage, your car loan, everything, to your yearly income. For a company, it tells us how many years of earnings it would take to pay off all its debt. And almost always, a lower number is better. It just means less risk. So FedEx reports a leverage ratio of 1.9. Now, for an industry like logistics that has to spend a ton of money on planes, trucks, and buildings, a ratio under 2.0 is generally considered really healthy and very manageable. But honestly, the most important bit of information here is the confirmation that they are in full compliance with all their financial covenants. Those are the rules set by their lenders. Being in compliance means they have plenty of breathing room and aren't at risk of any debt problems, which gives them the flexibility to invest or just ride out a potential downturn. All right, so you have to remember that reported profit under accounting rules isn't the same thing as actual cash in the bank. Accounting can be a little funny. It recognizes revenue and expenses when they happen, not necessarily when cash changes hands. So to really check the quality of those earnings we saw, we have to follow the money. And for that, we turn to the cash flow statement. It is the ultimate truth detector in financial analysis. And here is the proof in the pudding. The cash that the company generated from its day-to-day business surged to over $3.6 billion in the first half of this fiscal year. That is a massive increase of over $1 billion from the $2.5 billion they generated last year. This is what confirms that the profit improvement we saw wasn't just some accounting gain. It's a real, tangible improvement in the company's ability to generate cold, hard cash. And that is the lifeblood of any business. This slide is great because it shows you exactly how they get from reported profit to actual cash. You start with the net income of almost $1.8 billion. Then you add back over $4 billion in things that aren't cash, like depreciation. It's an expense on paper, but no cash actually left the company. After an adjustment for something called working capital, you get to that strong $3.6 billion in cash from operations. But to get to the number that investors really care about, free cash flow, you have to subtract the money they spent on maintaining and growing the business. And that leaves us with almost $2.3 billion in free cash flow. This is extra cash that can be used to pay dividends, buy back stock, or pay down debt. It is a powerfully strong signal of financial health. All right, no deep dive is complete without looking at the road ahead. You know, in their official filings, companies have to disclose potential risks that could mess up the business. A couple of these really stood out in this report, and they definitely deserve our attention. First, there is a big operational risk. The FAA has issued a directive about FedEx's fleet of MD-11 aircraft. Now, these planes are the workhorses for their long-haul international cargo flights. Management says the impact was minimal this quarter, but they are explicitly warning that if this problem isn't fixed quickly, having these key planes grounded for a long time could seriously hurt their ability to move stuff between continents and, hurt their financial results. This is a big one to watch. And second, they highlight a major macroeconomic risk. Management is pointing directly at ongoing geopolitical conflicts as a drag on the global economy. For a company whose entire business is global trade, this is not some abstract idea. It means real things, like higher fuel and insurance costs from having to reroute planes and ships. It means sanctions messing up trade routes. And it just means general uncertainty that makes people and businesses buy less stuff. This connects right back to those weak international numbers we saw earlier, and it's a huge, persistent risk. So, after digging through the income statement, the balance sheet, the cash flows, and the risks on the horizon, it is time to pull all these threads together. What's the final verdict? How do we take all this information and boil it down to a clear, concise thesis on how FedEx is doing? Based on all the evidence we've just walked through, pulled directly from their financial statements, our conclusion is clear and simple. The company's performance is demonstrably improving. This isn't a guess or a feeling, it is a conclusion based on the data. And critically, this improvement seems to be driven by their own deliberate, successful actions. And our thesis rests on three very distinct source-based reasons. First, that surging profitability. The 200 basis point margin expansion, driven mostly by that 91% drop in optimization costs, shows their big restructuring plan is paying off big time. Second, the robust cash generation. That leap in operating cash flow to over $3.6 billion proves these profits are real and tangible, not just some numbers on a page. And third, you have to look at the confident shareholder returns. When a company's board authorizes a massive $5 billion stock buyback and raises the dividend, that's management shouting from the rooftops that they are incredibly confident in the future. And this leaves us with one final big question. FedEx has clearly done an excellent job of controlling what it can control, its own internal costs and operations. They have put their financial house in order. But as we saw with those international numbers and their own risk warnings, their fate is still fundamentally tied to the health of global trade. The big question going forward is whether this new internal strength, this new efficiency, can build a fortress strong enough to handle any potential economic storms on the horizon. Thanks for joining this deep dive.